What's up, you guys? It's Graham here. So you really got to see this. Today, it takes more income to buy a home than at any other point in history. Mortgage demand has also fallen to a 27-year low, and the housing shortage is continually getting worse. So that begs the question, with today's prices, is it cheaper to buy or rent? And which option is going to save you the most amount of money long term? Well, to answer that, we're going into the trenches and looking up the true cost of ownership throughout each option across the United States. And I promise by the end of the video, you're going to be completely surprised by the results, because it goes against almost everything you probably ever heard. Although before we start, if you find these videos helpful, all I ask in return is that you hit the like button or subscribe. That's it. It helps with the channel tremendously, and as a thank you for doing that, I will do my best to respond to as many of your comments as possible. So thank you guys so much, and also big thank you to Experian for sponsoring today's video, but more on that later. Alright, so as a bit of a background, there's a general mindset that renting is throwing away money. Things like Rocket Mortgage or Zillow offer options with payments as low as 1% down. In most situations, lenders require a deposit, anywhere between 10 to 20% of the purchase price to get the loan, which usually amounts to tens of thousands of dollars. Second, you also have to consider your mortgage interest rate. This is going to be your cost of borrowing money. And today that cost is going to be the highest it's been in more than 20 years at just over 7%. This means every year, 7% of your mortgage balance is being eaten away into the abyss of monetary policy. And it adds up, as you're about to see. That's because third, if you put less than 20% down on a property, in a lot of cases you're also going to be responsible for PMI. This stands for private mortgage insurance, and it's an extra cost that you pay on top of your mortgage to protect the lender in the event you stop making your payments. The cost of this varies depending on your lender, but it usually ranges anywhere between 0.5% to 2% of your mortgage balance every single year. From there though, fourth, we also have property taxes. In terms of how much this adds if homes are said to be underinsured, expect that you'll pay more like $2,200 a year for the proper coverage. On top of that, you also have to consider repairs and maintenance. That's because almost everything in your home has a lifespan. For example, your roof will need to be replaced every 20 years to the cost of about $12,000. Water heaters need to be replaced every 10 years at $2,200. Tiles will break, garbage disposals will have to be replaced every month. That was a joke. But over the long term, it's recommended that you budget anywhere between 1 to 2% of your property's value each and every year for repairs that will eventually come up. So with all of that information, here's how much it'll actually cost you to own the average home here in the United States. Let's just take the example of buying a $400,000 home. At 10% down, that means you'd be coming out of pocket $40,000. You'd then be receiving a loan for $360,000, which at a 7% interest rate brings your monthly payment to roughly $2,400 a month. If you pay PMI on that, you're then responsible for another $150 a month on top. If you think it stops there, oh no, it's just the very beginning. That's because every month you make your mortgage payment, a portion of that payment pays down your loan balance, almost like a forced savings account. And in the first year, that amounts to a $3,656 savings, or $304 a month. You're also able to deduct the mortgage interest that you pay against your income up to the first $750,000 of a loan. Although since doing this makes you choose between the standard deduction and the itemized deduction, the true net cost of savings is more like $2,500 a year, or more like $204 a month. And finally, there's also the state and local tax deduction of $10,000, but since this also applies to income and only 30% of Americans even use it, we're just going to be excluding this from the numbers since it's not going to make a substantial difference. Anyway, that means at $3,463 a month, once you account for net tax savings and mortgage equity, you're left with a payment that's more like $2,955 a month, which seems a lot more reasonable. More nuanced factors to consider, like long-term home appreciation, which tends to keep pace with inflation. But since everything else, like property taxes, insurance, labor, repairs, and maintenance, also tends to go up in price alongside with it, let's just assume a more reasonable number is that your home will go up in value on average, net in your pocket by 1% each and every year, or for purposes of this calculation, $330 a month. This means the real cost of owning a $400,000 home, net out of pocket after expenses, after deductions, and after long-term appreciation, is likely going to be about $2,825 a month. However, this is where things get interesting. But before we go into which option is actually cheaper, let's talk about rent. Fortunately, this one is fairly easy. The price you pay is the price you pay. There's really nothing fancy about it. So that then begs the question, can you rent a $400,000 home for less than $2,825 a month? Well, according to this chart here, the answer is yes. In fact, go ahead and take a look at $400,000 homes across the country and then look at comparable homes for rent less than $2,900 a month, and you'll be surprised. In almost every city, the cost of renting is going to be substantially less than the cost of buying. And that leads me to wonder, in what scenario does buying a home even make financial sense right now? Although before we go into that, I think it's really important to mention that regardless of whether you decide to buy or rent, it is essential to build a good credit score. That's why one of the best ways that you could build your credit is with our sponsor, Experian. Look, without getting too complicated, here's how it works. Experian offers a free service called Experian Boost that analyzes your existing recurring charges, like phone bills, utility payments, and rent, and then they could add those as positive trade lines in your credit history to help boost your FICO score, even if you've never had a credit card before. However, if you now want to take this a step further, they've just launched an all-new Smart Money digital checking and debit card that allows you to automatically build and improve your credit score by doing what you're already doing, along with extra tools to help you monitor and improve your financial direct deposit with your Experian Smart Money digital checking account. You'll also receive early paycheck access and $50 cash back. So get started today and sign up for the brand new Experian Smart Money digital checking account by going to Experian.com/Graham or using the link down below in the description. It's time to build your credit without going into debt. And now with that said, let's get back to the video. Alright, so in terms of which option is actually cheaper, whether that be buying or renting, here's the kicker. The average American only stays in their home for 13 years before moving. And that means we need to compare that timeline with the cost of renting to see which really comes out ahead. In this case, assuming the same $400,000 home, after 13 years of making mortgage payments, your loan balance would be reduced to $276,000. And at 1% appreciation, your home value would be worth $450,000. This means you would be left with $423,000 after paying 6% in closing costs, of which $276,000 is your loan balance, and that leaves you with a... But that also means renting is the cheaper option at today's prices if you don't intend to keep your home for longer than 10 years. Although just like our last example, things still don't end right there. Unfortunately, these examples aren't so black and white because there are so many variables that could occur that are outside of our control, like interest rates, insurance rates, property taxes, and inventory. But across a wide spectrum, here's been my experience of why renting is better. First, if you don't intend to stay in your home for at least 7 years, then renting is cheaper. That's because you're not going to have to come out of pocket for closing costs, commission, escrow costs, title fees, and a whole bunch of miscellaneous expenses that quickly add up, which usually amount to about 6% of the purchase price. So unless your home goes up in value a lot in a short period of time, it's unlikely that you're going to recoup those costs anytime soon. Second, renting is also better if you could make a higher return from your down payment. For example, if you're running a business where tying up $40,000 would wind up making you significantly less money, anything else that goes wrong with the home, you as the tenant just pay one fixed price every single month and you're done. And finally, renting is better because you have flexibility. The thing is, with renting, you get up and leave as soon as your agreement is over. There are no commission costs of moving. And when there's a lot of competition on the market, like there is right now, you have a lot of leverage as a tenant if you're offering a quick move-in with good references. Of course, the downside of renting is that, number one, you're at the mercy of the landlord. This means if a landlord wants to abruptly raise your rent for no reason at all after the first year, an absurd amount, even if it's above market rate, in most places they can. The second, your rental cost is also not going to be locked in, and you're at the whims of the market. Even though that might work in your favor if prices go down, that's not guaranteed to happen, and prices could very well continue going higher, even outpacing that of homeownership. Third, you also have no freedom to customize the home as you like. This means no painting walls crazy colors, no building your own patio deck, no redoing all the landscaping and adding sculptures to fit the aesthetic. Although just like there are some negatives, we also have to talk about some of the positives when it comes to owning. First, long-term owning still tends to be the better choice. Even though the market could certainly go down in the short term, long-term housing prices have proven to be fairly resilient, and because of that, the longer you wait, the more likely it is that you're going to come out ahead. Second, by owning a home, you're going to be locking in your monthly cost until the home is eventually paid off. Now, even though things like property taxes, insurance, and ongoing maintenance is going to get more expensive as time goes on, your fixed monthly costs are going to be the exact same. And third, when you buy a home, there's just this psychological element of the home being yours. This one is kind of hard to explain, but there's a sense of freedom that comes along with owning your own home, being able to do whatever you want, and not being at the beck and call of a landlord. If you want and value stability, owning a home is priceless. But even though it's priceless, there is a bit of a cost. Like one, you'll be tying up a lot of money. By making a down payment, what you're really doing is locking away money in a property that's completely illiquid with no way to get it back without. If that's the case, you would have to come out of pocket to bridge that difference between what you owe on the home and what you could actually get for it in the event that you want to sell. This means if you want the too long didn't pay attention summary, this is all you need to know. If you intend on living in your home for less than 10 years, then renting is usually the cheaper option. If you want to manage your cash flow without coming out of pocket a significant amount of money, then renting is also usually the cheaper option. This also applies to the flexibility if you want to pick up and move on a short notice. However, if you plan on living in the same place for more than 10 years, then buying is usually better. If you want to remodel or upgrade your home, then buying is also better. And if you want to lock in your payments to invest in the area, then buying is better. My personal preference with this is that if you're going to buy something, at least buy something that needs a little bit of work, fix it up, and use that equity as a bit of a buffer in the event you need to sell and you don't want to come out of pocket in the event property values didn't go up as much as you expected. Obviously, every situation is different and every area is going to have different numbers, but overall, this rule of thumb should hold true. And if you want more information on this than I'm able to include in a YouTube video, feel free to check out my newsletter down below in the description, and that'll include the New York Times rent versus buy calculator so that way you could plug in your own unique options and see which one is really better, renting or buying. So with that said, you guys, thank you so much for watching. As always, feel free to hit the like button, subscribe, and don't forget that you could get some free stocks worth all the way up to a few $1,000s when you make any deposit using the paid affiliate link down below in the description. Let me know which free stocks you get. It takes you like 10 minutes to sign up. It's a pretty good ROI. Let me know on that. Thank you so much, and until next time.